Sure, there's volatility along the way, but it's almost Buffett-like. Like if my favorite chart in the world is this one that we put up sometimes, like it basically the chart of gold since 1971 when Richard Nixon closed the gold window and the purchasing power of the dollar. And it's a giant X.
Perfect.
Like that is a 70+ year trend, and it's a giant X, somewhat curved, but giant X. And I really think, okay, like what stock am I going to buy this week? That chart doesn't help me. But in terms of understanding the fundamentals, I really think that's all you need to know. Like this is the fate of fiat. It's, always goes towards what Doug Casey used to call its intrinsic value. Well, let me put it this way. Never mind me, tinfoil hat Lobo. Look at successful people. Look at your Rick Rules of the world. What if you've interviewed Rick recently, or if you've seen his recent interviews, he's taken a lot of profits. It's like people get all bent out of shape because I'm not saying silver's going to the moon tomorrow. But I'm not saying to sell silver. I'm not saying to get out of silver. I'm not articulating a bear market, but I have said locking in some gains is not a bad thing to do. And I have done that myself. I have one silver stock that it's really gone screaming up this year. I had like 3.5x on my investment. And there was significant risk in the play. So I took, just for round numbers, let's say I put 10K in and I had 35K sitting in my brokerage account. I took 20K out. That left me with 15K still in the play. So I have 150% as much money on that stock as when I started, but I have a double already in the bank. I would say cash in hand, except that I used it to pay off my mortgage or pay down my mortgage. But you understand what I'm saying? Like I have a guarantee, like if the rest of that goes to zero tomorrow, like the project is nationalized and there's instantly no liquidity and I lose every penny I've left in that, I still have a double because I already took that money back off the table. And if you say, oh, well, Lobo, you lack conviction, silver's still going higher. Well, I have 150% as much money as when I started in that play. And so silver has continued to go on higher, and I have continued to make more money on that. And so I started to say, set aside Lobo for a moment, but that example just strikes me as being, a number I can put my claws on is for what Rick's talking about. And so, you imagine you're at a bar and your favorite team is on the screen over the bar and all your compatriots around you, you're all, cheering for the same team. It is perfectly appropriate in that setting to be cheering for your team and saying, yeah, we're going to get the next, next first down or whatever, or, next whatever. But if you're a public figure who many people look to for guidance and will risk their hard-earned money on what you say and do, well, it's not the same. And if you cheerlead for your team, gold, silver, whatever it is, and people pile in at a peak and then get chicken out, lose confidence and sell low later, you can hurt a lot of people. So one thing is, you shouldn't despise the voice of reason for not being a cheerleader for your favorite thing, because they're trying to help. And the other thing is, look at your Rick Rules or beyond our world, the Howard Markses, or the Jeff Gunlocks of the world, these very successful people, or even Warren Buffett. Like, you have to take the profits. No profit is a real profit until you realize the gain. You can say, oh, you lack conviction. Oh, it's going to the moon. You shouldn't even think about taking profits. Well, for some guy on Twitter to say that doesn't really maybe do a lot of harm. But for big investors who have a following to do that, but they don't. Like, if you want to look at what do people who actually have money do, they take profits. I'm saying two things. One is, look at what successful people have done, and you can discount me. And I'm maybe not successful. I'm just little old Lobo. That's fine. Ignore little old Lobo. Look at whoever you do respect. Any notable financial figure who's made a great success as an investor, they didn't get that way by saying, yeah, it's going to the moon. I'm going all in and I'm getting a triple mortgage on my house, right? No, they got there through reason, discipline, including taking profits as they materialized. So that's the recipe for success. You may or may not like it. Tom, you'll get more clicks if I say, it's going to the moon. But if you want to help people make money, that's the lesson to learn.
There is a critical difference between personal speculation and public influence. When market commentators cheer relentlessly at elevated prices, inexperienced investors often enter late, absorbing the risk professionals quietly exit. This dynamic has repeated itself across cycles, from tech stocks to commodities. Caution should not be mistaken for pessimism. Thoughtful analysis exists to protect people from emotional decisions, not to dampen optimism. Markets reward patience and punish blind enthusiasm. The voices urging moderation often do so, not because they lack conviction, but because they've seen how quickly sentiment can reverse when momentum fades.
I think, again, Rick has said this in his recent interviews. The answer isn't, oh, well, if I was younger again, then I would unlearn, my caution or whatever. That's not what he's saying. Yep. What he's saying is you have the awesome opportunity of being young enough that if you do make mistakes, if you swing for the bleachers and you lose, you can pick yourself up off the ground and dust yourself off and do it again. You've got that time. Whereas a retired person on fixed income doesn't have that luxury. Though I actually like to say that 19-year-olds and 90-year-olds are in much the same boat. When you're 90, your kids and your grandkids are already grown up. Unless the nanobots come tomorrow and extend our lifespan by triple or whatever, how much more money are you going to need? And you can afford to take chances at 90, I think, not with your nest egg, but with your disposable cash. The money that you might take to Vegas to go play for a while, you could take to the casino of the TSXV, right? Or the OTC in the US. So I think it is legitimate for somebody with different consequences for taking risks to make different choices. And sure, if I'm 19, no kids, not even a girlfriend, and I take a chance on some big thing, some new crypto or pot stock or whatever, or meme stock, and I get lucky and I make a bunch of money and I become a millionaire, sure, why not? Take a chance. Just don't confuse that with disciplined speculation. That is a form of gambling, and if you get lucky, great. Now, what my pushback would be, not that you should do different when you're 19 and you're looking for a chance. If you like buying lottery tickets, I can't say that you shouldn't. But if you win the lottery, if you pick the right shit coin and now you're a crypto millionaire, don't you want to protect that? Don't you want to separate out, a chunk of it to deploy wisely, carefully, for maximum gains with a reasonable amount of risk versus the high risk pool that you can continue to play with and gamble with and swing for the bleachers on. So I'm not sure I've wandered off your question there, but I do think it's a legitimate question, and I do think, sure, different marching orders, but the takeaway is the lessons that you learn in the school of hard knocks, they're not suspended just because you're younger or you have a different risk profile. You should make a conscious decision of, okay, I'm interested in the very high stakes gamble here, and I'm willing to take that risk. So I'm willing to set aside best practices in order to have a chance at this moonshot here. If you do that consciously and you lose all the money and you know that could happen and you're okay with it, I'm not going to do that. Rick's not going to do that. But I'm not going to say somebody's wrong for doing that. Just they need to be aware. It needs to be a conscious decision that I'm doing this, instead of being talked into it by some guru on YouTube who says, oh, bye, you can't lose. It's going to the moon tomorrow.
Risk tolerance is not universal. A young investor with minimal obligations can afford aggressive bets and recover from losses. A retiree living on fixed income cannot. Yet discipline applies to all ages. High-risk speculation should be a conscious decision, clearly separated from long-term capital preservation. Even windfall gains, from crypto, commodities, or speculative equities, demand structure. Successful investors isolate winnings, protect core capital, and limit gambling to money they can lose. The difference between strategy and speculation is not age, but awareness. Knowing why you take a risk matters more than the size of the risk itself.
Right. Yeah, that has been my concern. And if you're a TA, right, you're supposed to be agnostic to what's happening in the real world. Just price tells you more than your best friend or Rosencrantz and Guildenstern or whoever can possibly ever tell you. Just look at the price, and it's the distillation of everybody in the market, right? That's the idea. But I don't want to piss too many people off here, more than I already have, but I just can't go there. Like,
let's frame it as making
the real world exists, and I just can never concede that it is a mistake to look out the window and see what's going on in the real world. It's like the weatherman who has their theories and their measurements and stuff, and they have no window in their studio, and they can't see that it's raining and hailing while they're talking how sunny and shiny it is, not realizing that the radar is stuck and pointing in the wrong direction or something, right? So I'm always in favor of looking at the real world and the relevance to this right now, specifically for silver. I have been concerned. I have been writing about, like, be careful what you wish for. If silver is now in that catch-up phase, that is a signal of the end of the bull market. And as a fundamentalist, I don't think that's where we are. But that's what that would signal if silver is finally catching up with gold. And by the way, it has. People say, oh, well, gold's hit an all-time high, even on real terms, and silver hasn't yet, or gold's way above its previous peaks and silver isn't yet. And I think it's a mistake to compare previous peaks. Those are, by definition, outliers. Mm-hmm. But that aside, you don't calculate a gain from a peak. You calculate a gain from, trough to peak. So the last cyclical low was in late 2015. And if you look at gold and silver since that late 2015 cyclical low, silver has now more than caught up with gold. That has to be a concern. That is a red flag. Even the most diehard silver bulls in the world will tell you that silver lags gold at first and then more than catches up in the end. So if it's more than catching up now, how can you not? Like, you can celebrate that. Ooh, I'm long. Yay, it's going up. But how can you not be concerned that that is signaling, or maybe signaling, the end of the bull market? And so I have that concern, but my answer to it, the reason why I'm not selling my silver stocks, yes, I've taken some profits, but I'm still long. And the reason for that is there are silver-specific supply constraints affecting the silver market that are not affecting gold or platinum and palladium either, by the way. And I do think those will be worked out in due course. So I think silver is catching up, or has more. The gold-silver ratio, to your question, has closed dramatically in recent weeks, in the last couple of weeks. But I don't think that's because we're in the blow-off top phase. I think that's because of idiosyncratic factors in the silver market that are temporary. And so silver bulls, they don't want to hear temporary. They want to hear silver going to the moon. And I'm saying, well, wait, that means the market's over soon. That's not what any of us wants. So what I'm saying is, I think, yes, silver has gotten a bit ahead of itself because of these supply issues, the London physical shortage and all that. And if that, or when that sorts itself out, then silver corrects and consolidates. And I think that sets us up for even bigger gains going forward, more than if we got the blow off top now. So my answer is that, if I just looked at the data, I'd probably be much more worried about where we're at right now than I am. If I just looked at price, I might be selling, like just closing out some of my silver positions or even gold positions, because both of them after the peak would go down. I might be looking at a larger, if not wholesale, rotation out of gold and silver into copper or other things. I'm not, because I think that the signal that silver is sending right now is not a false signal exactly, but it's a temporary surge that I think will smooth out and will revert to trend, which is upwards later. So that's my hopeful thing. I could be wrong. It could be that we are facing the blow off top. And the one thing I say to people is that I don't think so. Like, I'm planning for a more staggered, steady climb up for years ahead. But if you think we're in the blow off top phase now, the way to play that is actually to buy the majors, to buy the biggest gold and silver stocks, the go-to names. And I don't need to name names. You know who they are. Like, somebody, a newcomer to the space, says, oh, what's a gold stock? What are they going to find if they type gold stock or silver stock? You know who they are. those would be the beneficiaries of the dumb money that comes late to the party. The generalists just whoosh in at that vertical blow off top. Those would be that's why Doug Casey, my mentor, used to call these the go-to companies. When people get excited about something, where do they go to? They go to those famous names. So I'm not recommending this. I'm saying if that's what you believe, we're in that blow off top phase, that's how you play it.
Silver's recent surge deserves both celebration and scrutiny. Historically, silver lags gold early in bull markets, then accelerates aggressively near the end. Today, silver has not only caught up, it has temporarily outpaced gold since the last major cycle low. That pattern often raises caution flags. However, current conditions are complicated by real-world supply constraints, particularly in physical silver markets. These bottlenecks can exaggerate price moves without signaling a true market top. If resolved, consolidation could follow, creating healthier conditions for sustained gains rather than a destructive blow-off peak.
Tom, and actually, like the mining industry, frankly, they just flubbed it last time. When we had that big surge, this is another Rick Rule thing, like it really takes, concerted effort and talent to take a 7-fold increase in the underlying commodity, gold, and turn that into increased negative free cash flow, which did happen. Like I've charted that. The industry took this huge increase in gold and turned it into an even larger gap, negativity in free cash flow. And I think that has a lot to do with why the stocks underperformed the metals this time, because recency bias, people were once bitten, twice shy about that. But now those companies, they are like literally printing cash in the sense that like they're mining real money out of the ground, gold and silver. And at phenomenal, like the quarterlies that we're going to get for this quarter they're going to be amazing. You'd have to be, again, a spectacularly incompetent miner to not just make gobs of money at these levels. And, people will get mad at me for even considering the potential downside. But, I'm a due diligence guy. I'm not a cheerleader. So if we consider the potential downside, let's say that it's not just a shoulder. Let's say the worst case scenario here, and you asked about what do we learn from 2011, right? And I know we were trying to wrap up, but I think this is important. Like, let's say that we've just hit a peak. Like just right now, as you and I are speaking, it's peaked again. It's 2011 all over again. And the next thing that's going to happen is going to be a multi-year bear market for gold and silver. If that happens, gold retreated about 50% over those years from 2011 to 2015. A 50% retreat from $4,300, $4,400 gold is still 2,000 and change. That is a price well above the all-in sustaining cost of most of your gold miners. I mean, it's a pretty crappy gold miner that has costs above that. So, if that's our worst case scenario, because gold's not going to zero. I actually did the math on this. Even pet rocks are up like 6.5 times over what they were in the 1970s. So if you say gold is just a pet rock, you're still looking at a huge increase. Like it's not going back to $42, right?
Where did you find
or 258, right? So anyway, I don't think this is going to happen. I don't, with the central bank buying and all these other things going for gold and silver, I don't think we're going down anywhere near like that. I'm just saying, like as a thought experience, if our worst plausible case is something like 2011 all over again, one, the miners will still make money. Two, if the worst possible timing, you top tipped that market in 2011 and you bought gold that day, you're actually 2x your money now. Like so if you had the courage of your convictions and didn't panic out, you not only were made whole, you made money. And if you did have those courage of those convictions, you probably wouldn't have just held what you top ticked at that point. You would have averaged down, you would have bought the trough, and you could have made a lot. Like if you did buy the trough in 2015, you made a lot of money. So if that's the worst case scenario for people who get it, who understand these markets, that's not the end of the world. But that's actually not my expectation. My base case is consolidation sideways with volatility, including negative volatility, before the next big move, which I do think will be upwards, because the debasement trade is nowhere near over. It's just funny that Wall Street has suddenly discovered the debasement trade that we've been talking about since 1971. Mm-hmm. Sure, there's volatility along the way, but it's almost Buffett-like. Like if my favorite chart in the world is this one that we put up sometimes, like it basically the chart of gold since 1971 when Richard Nixon closed the gold window and the purchasing power of the dollar. And it's a giant X.
Perfect.
Like that is a 70+ year trend, and it's a giant X, somewhat curved, but a giant X. And I really think, okay, like what stock am I going to buy this week? You know, that chart doesn't help me. But in terms of understanding the fundamentals, I really think that's all you need to know. Like this is the fate of fiat. It's, always goes towards what Doug Casey used to call its intrinsic value.
Even if precious metals were to repeat a 2011 style correction, the downside is frequently misunderstood. Gold and silver mining costs today are far below current prices, meaning producers remain profitable even in steep pullbacks. Long-term holders who endured prior bear markets eventually recovered and prospered, especially those who averaged in during weakness. A correction does not erase the structural drivers behind precious metals. It resets excess optimism, shakes out leverage, and prepares markets for the next advance. Volatility is not failure. It is the price of participation in real asset cycles.
Couple of things. One is, I think all credit where due. I think Lynn Alden absolutely nailed the fiscal dominance thesis early before everybody else did. And not 24, but 23, and then bleeding into 24, I think I completely underestimated that factor. And, I was one of the people who really thought we would get an undeniable recession, not just a K-shaped economy or a rolling recession, but something the NBER would actually recognize a recession. And I was wrong. There's one I got wrong. That wasn't this year. That was the year before. And this was the reason why. So, the relevance to your question is, in a period of fiscal dominance, the Fed's policy tools are, if not completely useless, at least much less useful. Pushing on a string comes to mind, right? And we've seen this. I mean, right now, just as you and I speak, the Fed just cut again. And what happens to the part of the yield curve where people actually do business, right? Mortgage rates go up, 10-year goes up, 30-year goes up, right? They cut rates and real world interest rates go up. That's not what's supposed to happen. It's funny. I posted on Twitter about this backfiring, and today I've seen headlines about backfiring. And so anyway, what I'm saying is not that the Fed no longer matters, that it's unimportant. We do see, moment to moment wiggles in various markets that matter to us when the Fed says or does something. But that's tends to be short-term noise. I do think that fiscal dominance means that the impact of those policies are not as strong as they would be. That having been said, both argue for the monetary metals. Like the fiscal dominance is inflationary. The weaker Fed policy, like we all know, whoever the Trump appoints, he's going to be a super dove. And, we just got today these lower inflation prints as we speak. We got surprisingly lower U.S. headline and core CPI. And initially, the market's been quite volatile on this. But the interesting thing is, apparently, I haven't had time to look under the hood myself, but I've heard from people who have looked. And apparently, what the BLS did was that for some of those numbers that they didn't have for October, they just put 0 in there. So, I mean, these lower numbers are very likely to be reversed in the next report, but by then the Fed may have made its next decision, right? So we're going into a near-term noisy phase, but regardless, Trump is stacking the Fed to be dovish. So we're likely to continue to see more dovish policy anyway, regardless almost of the data. But the labor market data has been weakening. The unemployment rate surprised in the other direction, popped up to 4.6% in the United States. And by the way, to our global audience, quick aside, I understand the United States is not the entire world. And yes, other countries do matter. But commodities are still quoted largely in dollars. And, like it or not, the US is still one of, if not the largest economy in the world. So what happens in the US does matter. And it tends to move commodities prices. So it's not that I'm unaware or just so US centric that all I care about is the Fed or whatever. But, these things do matter, and they do impact or should inform our investment and speculative investment decisions. Mm-hmm. So long story short, the labor market in the US continues to weaken. I think the inflation beat is questionable, but the Fed has clearly decided that it's going to weigh more on the side of labor than inflation. And Trump's pushing that direction anyway. And then you've got the fiscal dump. So like all roads lead to inflation, no matter who gets in or what. I think almost regardless of the data, until inflation really starts taking off again, it's a foregone conclusion of more easy monetary policy. And as far as it's not just a big, beautiful bill. Again, as you and I speak, Trump just announced $1776 checks going out to the military before Christmas. The checks are in the mail already. From what money? Like we just had a government shutdown, and we're facing another one next month because, where's the money coming from? I don't know. We just print it. But those checks are on the way. And by the way, I'm not hating on veterans here or anything like that. I'm just talking about the check printing. Okay? That's inflationary. And so my answer to your question, Tom, is everything I see, not just in the US, Europe's rearmament and, China's desperately trying to create more inflation. The only ones who seem to actually still be on the let's not have any more inflation bandwagon are Japan. But, that's an outlier, and they're having trouble. Anyway, I think all of this is extremely bullish for anything governments can't print into existence or loan into existence. And that includes anything real. But obviously monetary metals are a strong beneficiary. And this is part of why I believe in that shoulder consolidation before move higher rather than a peak and now it's a bear market for gold and silver. I really don't know, Tom. This is one of those ones where I should remind the audience that I'm actually not an economist. I'm just a due diligence guy. People pay me to kick rocks. What do I know? But I will say that there is a possibility, like there is something to the fake it until you make it concept. Like it's inconceivable to me. Inconceivable. There's another movie reference for you, Tom. It's inconceivable to me that somebody as intelligent as Scott Bessent appears to be is not aware of the utter drivel that he pours out on a daily basis to reporters. I don't think he can believe really half of what he's saying or be unaware that he's dodging the real issues with smoke and mirrors. I think it's deliberate. Now, is it for an important cause? Maybe. If you gave me a choice right now, hey, Lobo, would you rather live in a world completely dominated by a one world government run by Putin or Xi or Trump? I'd pick Trump. So maybe it's all for a good cause. I don't know. That's above my pay grade. But if that were so, and that's how you saw the world, like if these guys in the administration really think that this is the grand Game of Thrones that they're playing and they got to come out on top, then that justifies anything. Truth be darned. So, and maybe it works. Like maybe they get people going again, and maybe the reshoring happens, and maybe it works before Trump's term is up. The more difficult thing would be to have it kind of sort of working before the midterms, and that's looking doubtful, which makes it more difficult for things to happen in the rest of Trump's term. So I can't say I'm entirely optimistic here. What I can say is that all these $18 trillion, $20 trillion, I don't know how many trillion dollars the latest number is that Trump says is being invested in the United States, it has not resulted in a manufacturing renaissance yet. And you look at the Empire State or the Dallas Fed or any of these, the national business, like all of these things are showing, with some volatility, basically manufacturing decline that has not reversed. So can they fake it till they make it? Maybe. Is that the right thing to do? Maybe. I don't know.
Mhm.
Is it happening now? Not yet. Not visibly, not in the data yet. We'll see.
The global financial backdrop continues to favor tangible assets. Fiscal dominance, persistent deficit spending, geopolitical fragmentation, and weakening confidence in fiat currencies all reinforce demand for scarce, real-world resources. Central banks still accumulate gold, while governments expand balance sheets to manage slowing growth and social pressure. Monetary easing may no longer stimulate growth effectively, but it continues to debase currency purchasing power. In that environment, assets that cannot be printed, gold, silver, and real commodities, retain strategic value. The path forward may be uneven, but the long-term trend remains firmly grounded in reality.